Chinese EV maker NIO has made noticeable progress in improving its vehicle margins despite China's fierce EV price war. In 2024, the company's vehicle margin rose to 12.3%, up from 9.5% in 2023. Meanwhile, Li Auto has built a strong reputation around its extended range vehicles, which offer both EV benefits and range flexibility. NIO stock price is down 20% year to date, whilst Li Auto has fallen only 4.5% since the start of 2025. So, if you're looking to invest in an EV stock for future growth, which is better, NIO or Li Auto? In this video, I'll try and answer this question by breaking down each company's model lineup, the recent sales numbers, and future plans. China's new energy vehicle market, comprising of battery electric vehicles and plug-in hybrid models, continues to thrive. More than 11 million EVs were sold in the country last year, up over 40% from 2023, according to the China Passenger Car Association. In the first quarter of 2025, sales of passenger EVs in China were estimated at around 2.86 million units, an increase of 43% from the same period last year. Chinese EV maker NIO has made great progress in improving its vehicle margins despite China's fierce EV price war. In 2024, the company's vehicle margin rose to 12.3%, up from 9.5% in 2023, and this was driven by stronger production volumes and cost optimization across its entire supply chain. Quarterly results also displayed steady improvements. Margins were 9.2% in Q1 2024, 12.2% in Q2, and 13.1% in Q3, amid lower material costs per unit, which were a key driver. While Q4 vehicle margin was flat compared to Q3, it was still reasonable given the brutal price war in China. And NIO targets a 20% vehicle margin for its namesake brand and 15% for its mass market Onvo line in 2025. Despite steady price margin progress, NIO is still burning significant amounts of cash. At the year-end 2024, it only had 2.6 billion in cash, with 1.56 billion in long-term debt. Its high debt to capitalization ratio of 76% does point to financial pressure, and NIO remains unprofitable. However, the company is investing heavily in its battery swap network, a costly operation, while competitors focus on simpler charging models. In addition, vehicle deliveries fell to 42,094 units in Q1 2025 from 72,689 units in Q4 2024. And investors are waiting for more than just cost cuts. NIO needs to double down on its marketing, launch new models, and boost revenues without relying on price cuts. Its overseas push, especially in Europe, faces challenges, including heavy tariffs. Until NIO proves it can grow profitably in this highly competitive environment, the stock price may continue to lag. While it's aiming for break-even by the fourth quarter of 2025, achieving this goal will be challenging. Meanwhile, Li Auto has built a strong reputation around its extended range electric vehicles, which offer both EV benefits and range flexibility. Each of its popular L-series vehicles, including the L6, L7, L8, and L9, have all delivered over 200,000 units. Last year, the company launched its first pure battery electric model, the Mega. Li Auto plans to launch additional battery EVs, including the Li i8, i6, i7, and i9 over the next 12 to 18 months. And the Li i8 is expected to launch in July this year, while the i6 will be released later in the second half of 2025. Meanwhile, NIO has been focusing on building pure EV models only. NIO's vehicle lineup includes the ES6, ET5T, ES8, EC6, ES7, ET5, ET7, EP9, EVE, ET9, and EC7 models. And in late March 2025, the company commenced delivery of the flagship NIO ET9. Besides the NIO series, the company has two more brands: mainstream mass market brand Onvo and high-end small car brand called Firefly. Onvo's first model, the L60, has been well received, but sales have been slow. And its second product, the L90, is expected to begin deliveries in the third quarter of 2025. Onvo's third product is planned for launch in the fourth quarter. Meanwhile, Firefly's first model is set for launch later this month. Li Auto's deliveries are significantly higher higher than NIO's. Li Auto delivered 92,864 units in the first quarter of 2025, up 15.5% year over year. Li Auto delivered 500,000 vehicles in total in 2024, up 33% from 2023, with over 500,000 annual vehicle deliveries within just 5 years of the company's first delivery. Li Auto did set a new benchmark as the fastest growing premium auto brand in the Chinese market. And in the first quarter of 2025, Li Auto has already delivered over 92,000 units, in line with its sales targets, which is an increase of 15.5% year over year. Li Auto's cumulative deliveries totaled 1.226 million as of the end of March 31st, 2025. Meanwhile, NIO delivered 221,970 vehicles in 2024, marking a 30.7% year-over-year increase. Now, while that's impressive, it's less than half of Li Auto's total. In the first quarter of 2025, NIO delivered 42,094 units, an increase of 40% year-over-year, and within the sales target set by NIO management. As of March 31st, 2025, NIO's cumulative deliveries totaled 713,658 units. While NIO's pace is picking up, Li Auto remains far ahead in total sales volume. Looking at vehicle margins, the metric for Li Auto was 19.8% in 2024, down from 21.5% in 2023, but still better than NIO. Last year, Li Auto generated an operating profit of 961 million and a net income of 1.5 billion, underlining its status as a profitable EV maker. And Li Auto also leads comfortably in terms of financial performance. Its total revenues were 19.8 billion in 2024, up 16% year over year, with vehicle sales making up the bulk. NIO, on the other hand, generated just over 9 billion in revenues in 2024, an increase of 18% year over year, with vehicle sales accounting for 89% of the total revenue. The company incurred an operating loss of 3 billion. While it is aiming for break-even by the fourth quarter of 2025, profitability remains a challenge. While NIO is making progress, it's a long road ahead. To stay competitive, it must execute its 2025 targets and find new ways to drive growth without losing ground in the hyper-competitive Chinese EV market. One thing that makes NIO unique is its battery swap business. Right now, building out the swap station infrastructure is having a massive impact on the bottom line. However, in the future, the battery subscription model could be the biggest source of recurring revenue for NIO, with owners paying monthly to access fully maintained battery swaps. So right now, based on the financial data, Li Auto looks like the obvious pick. But long term, if NIO's innovative plans come to fruition, its investment potential could offer more long-term growth. If you want to learn more about NIO's long-term growth plans, watch this video next, where I look at the recent Q4 earnings report and discover the biggest problem NIO needs to fix to drive growth in 2025. See you there.